Test.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it's Monday as we get this new week going, and already it's been quite an interesting weekend, of course. President Biden dropping out of the nomination for the upcoming election. So the Democratic convention right around the corner. Kamala Harris has now been endorsed by the president. It's going to be interesting to see what happens. There were basically about 14 million votes that had been cast, for Biden. And of course, coming into the Democratic convention, they will have to nominate whoever it is, Kamala Harris, etc., give her the nomination for president. Of course, then she'll have to pick a vice president. So very big change in the political drama. Here we are, just literally, right? This is the last week of July for all intents and purposes. So August, September, October, 3 months. They've got to get this together, get a presidential campaign group put together and head into an election. So it's a very, very short window with that. Now, interestingly enough, over the weekend, the markets kind of went, eh. So we've talked about this before. The markets kind of sensed this was coming anyway. And so we didn't see a big shift in the dollar or a lot of other assets over the weekend. We'll see how the market plays out today. This will be the first trading day since that announcement over the weekend. So we'll kind of see how this works. Now, interesting looking at the predicted polls for the outcome of the election. The bit of a reversion there. You would expect that to be the case. Of course, a very dramatic drop in predicted polls for the election from President Biden, basically going to zero now since he's now stepped out. However, the odds of Kamala Harris winning the election has risen sharply. And there's been a slight pullback, a little bit of a reversion, and you would expect that, right? So if the odds are now increasing for Kamala Harris, you would see odds dropping a bit for President Trump. But there's still a big gap. Former President Trump still has a very commanding lead in the predicted polls. Now, we're not talking about straw polls. We're not talking about other just collected polls around. We're just talking about the predicted polls. This is the betting odds in Vegas about the outcome of the election. Also, interestingly enough, those same polls, those predicted polls, also expecting a Republican sweep of both House and Senate. So right now, it's going to be very interesting to watch how this continues to develop over the next 3 months. Of course, this has a big influence on what sectors, what markets, kind of where the markets are going to start placing their bets for the outcome of the election, right? So again, if it is expected that President Trump is going to win, we're going to continue to see potentially this rotation into areas like industrials, basic materials, energy, finance, healthcare, heading into the election. So we'll see what happens. But last week we did have this bit of a sell-off, and that's got everybody's attention. The question about that is, of course, I've got an article coming about on this tomorrow, is about this rotation and is it sustainable? And so we'll get into a lot more of that about on tomorrow's show. But the important thing here is that we have seen now initially this big shift out of the mega cap stocks, right? This certainly got everybody's attention over the last week. Companies like Nvidia, Microsoft, Apple, Tesla, having some decent corrections. But again, you got to keep this into context. They've had very, very big advances this year. So a bit of a pullback shouldn't really be surprising. It should actually be welcome. But it was interesting because we're seeing already lots of headline news, articles coming out. It's like the AI bubble just busted. It's over. It's done. Be a little careful with that. We've just had a very, very big advance in the markets, and a correction was possible. We've been talking about for weeks now about the potential for a correction heading into the election. And at the first sign of a bit of a sell-off, it's been interesting how quickly negative headlines became, how, already getting phone calls from clients and prospects like, oh my gosh, is this the one? We've been talking about this for weeks, right? Here's what you need to know before the bell this morning. So the market has had this very nice advance. So we had this correction back in April. So remember, let's kind of rewind the tape here for a second. February and March, we were on the show talking about, hey, we're very overbought, very extended for means. Markets are stretched. We're going to have a bit of a 5 to 10% correction. And we had a 5% correction in April. So right in line with what we expected, came down, tested the 100-day moving average. And the first sign of that to occur was this break of the 20-day moving average. And that 20-day moving average has continued to be really strong support for this rally all during that advance that we had, really kind of coming out of the November lows. That 20-day moving average was just kind of the running line. The market would come down, it would test it, it would rally off of that and just kind of keep grinding higher. It wasn't a big straight up advance. It was just a slow grind higher all along the way from November. But eventually the market got to a position, we had this correction back to the 100-day moving average. So this is kind of what we've been talking about over the last few weeks. The market's been once again kind of grinding right along that 20-day moving average. Now, on Friday, this was the first time that we broke the 20-day moving average since going back to April. So again, now this market could rally today, get right back above that moving average, and this won't be an issue, right? It'll be a test of the 20-day moving average, and this market will continue to grind higher. However, if we do get into a position where this market does spend a little bit of time below the 20-day moving average, and this is going to be something worth paying attention to, there is risk that we could go a bit lower here. Let's zoom here a bit. So we've broken below that 20-day moving average. The 50-day moving average is sitting right now at about 50.40, give or take. 5,400. And then right below that is about 52.50 for the 100-day. So we could have a decent correction here going into the election. And we've talked about this, kind of over the last couple of months. This is the first real kind of sign of weakness we've seen in the markets, a bit of profit taking coming out, repositioning. And of course, we saw this big rotation of the small caps last week. Now, is that sustainable or not? We'll talk about that tomorrow. But the issue here is that we're now starting into that process, potentially, of a bit more of a correction. We did get a decent MACD sell signal on Friday as well. This cross was pretty deep, and so that's enough to really suggest that we've now entered into potentially a bit weaker phase of the market. So this is why we were taking some profits last week out of stocks, book some of those gains, put those in cash. We're going to kind of let this market work itself out a bit. We're heading towards oversold on a short-term basis, but not really that oversold yet. So this market could, work its kind of grind here a little bit, kind of work its way lower. Again, if we go back and look at this April correction, which I think will be very similar to what we're talking about now, the market kind of broke that 20-day moving average, actually rallied back above it slightly, and then corrected again. So, it wasn't just an immediate sell-off. This market kind of worked its way through a process of that correction for a little bit of time. There's still a lot of bullish sentiment right now. People are still wanting to be invested, and we haven't really spooked those buyers out of the markets just yet. But again, as I said, back here in April, it took about a week or so before the selling pressure came in, and then we actually came down and tested that 100-day moving average. So again, we could see very much the same thing. This market kind of grind here a bit, and then start a little bit of a correctional process over the next month or two as we start to head into the election, de-risking, etc. Now, again, we don't know anything just yet. It's important. It says market rallies today back above the 20-day. It's a false signal here, and we could just kind of ride right back up to the recent highs. So this week will be important. It'll tell us a lot, and we'll keep you updated every morning as we go through our market process. But again, it is worthwhile to note that we are in a position of having a sell signal, take some profits, reduce some risk. We've been talking about it for the last couple of weeks. Still not too late to do that. It's still a good opportunity to manage risk in your portfolio. Okay, that's what you need to know before the bell this morning. We're going to come back, talk a little bit about the mega caps. Can they continue their dominance? That's the big question. We'll talk about that next on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Of course, it was an interesting weekend. Again, I was told it was supposed to rain all weekend. Didn't rain a drop at my house. So I got nothing. So I didn't wash my truck this weekend because everybody says it's going to rain. Well, so this morning come to work, they said it's an 80% chance of rain all week. So we'll see. But, this is a lot about predicting markets, right?
Should have washed your truck.
I should have. It would have guaranteed some rain if I would have washed truck. That happens every single time. So on Friday, I posted an article talking about the mega caps and, the kind of the big headlines this past week is that we saw this rotation from large cap stocks into small cap stocks. And immediately headlines were out from a lot of analysts, the AI bubble just popped. This is it. We're having a big rotation back into, small cap stocks, et cetera. Maybe, right? But it's way too soon to tell if that's the case or not. And it's a 1 week sell-off, and these stocks were extremely extended, right? NVIDIA, Apple, Microsoft, Google, they've had huge runs this year. And I mean, just a good example, back around middle of January, we launched our dividend equity portfolio on SimpleVisor. And the way that dividend equity portfolio is built, 30% of it goes into mega cap stocks. The rest of it is into value-oriented, fundamentally strong, dividend-paying companies. And the reason for the 30% ownership in the stocks is in the mega caps is that gives you some performance. So if the market's going up, those tend to perform with the markets. So you get a little bit of S&P performance while you also get the dividend yield from the underlying portfolio. Well, so is like January the 19th, we launched that portfolio and we bought NVIDIA. And that stock was up 95% before the correction, right? Just since January. So again, and this is the point, is to keep these corrections in the markets somewhat in context of reality, and understand that, look, things go up, things go down, and that's how markets work. But just because you have a bit of a correction in the hottest area of the markets, right, and then you had some money rotate from the hottest area of the market into some of the worst performing areas of the markets, doesn't mean that the previous chase is now over. It just means you're having a correction, a healthy one at that, and much needed. And again, these stocks weren't having a massive outflow of capital, right? These stocks weren't down 20 and 25% in a day type things, right? We were down 4%, 5%, 6%, depending on the stock. And that's a big drop for a day, but not for those particular companies. They can do that on a regular basis, and then they immediately kind of make it back up. So I'm not saying that's going to happen either. I'm just saying let's keep this into a bit of context within our portfolio management and not start extrapolating out that, oh my God, we've just had a paradigm shift within the markets. Now, could this be the beginning of a bigger rotation in the markets? Sure, it could be. We've talked about needing a rotation for quite some time. And it could certainly be the case. And again, we're going to talk a lot more about this tomorrow. And I have a lot of charts and graphs for you as well. But we just don't know. It's been a week, right? You can't say that we've seen these types of rotations in the markets before. They last a week or two and then they're over. And small caps have continued to underperform dramatically in particular, small caps, mid caps, the Russell 2000, basically every other asset class, whether it's bonds, golds, whatever it is, has all underperformed the S&P and NASDAQ since 2014, right? But we've seen these spurts of activity before, and then they fail. So is this the time that now we're getting this massive lift to the other asset classes and S&P will underperform? Maybe. Again, it's just way too soon to tell. It's been a week. So we'll see kind of what action does today. But the mega caps have some fundamental issues that drive those stocks in particular. And there's some things that just aren't going to change over in the course of a week. So first of all, and we wrote about this on Friday, is that there's fewer stocks in the markets to choose from. If we go back to 1996, there was over 8,000 publicly traded companies. Today, there's about 4,300 companies today. So as the size of the market grows, there's fewer and fewer stocks for those dollars to go into. And so that in and of itself drives those dollars into larger capitalization companies, because if I'm a hedge fund, if I'm a pension fund, et cetera, and I've got to move, if I'm CalPERS out of California as an example, or if I'm, BlackRock or some massive, fund company or a hedge fund, et cetera, where I'm managing, hundreds of billions or even trillions of dollars, I can't really go buy small cap companies because I simply can't put enough capital into those companies, because I'll move the price of the stock, because it's simply just they don't trade that much. There's not that much market capitalization to work with. So I can't go put the value of the company into the company. I'll just wind up owning the company, right? And so they can't do that. So because of size constraints, mega caps have a large cap companies and the mega caps have a consistent flow of liquidity into those companies because they simply have no other options. And they need liquidity, they need stability, and they need to be able to get access to that capital. So if something does start to go wrong, if I'm a big, massive hedge fund and I go put a lot of capital into a small cap company, great, I drive the price of the stock up. The problem is if I try to take my capital back out of the company, I'm going to crush the stock price, right? I don't have that problem with an Apple or Microsoft. I can move billions of dollars in a day, and I can take billions of dollars out and not move the price because it's so big and it's so heavily traded. So liquidity in the large caps is a big driver for why money keeps flowing into those companies in particular. And there's nothing right now that suggests that that has changed at all. The other problem with the small cap trade, again, so, you know, I'm a big, massive hedge fund manager, et cetera, and I've got to move capital. 40% of the companies in the small cap index, the Russell 2000, are non-profitable. So am I really going to invest a massive amount of capital into companies that are non-profitable in probably one of the greatest economic environments that we've had in quite some time because of all the liquidity and the stimulus, et cetera? So again, you know, there's just fewer companies that I have to choose from in order to invest capital. And this is why we've seen this massive concentration within the markets that over the recent years of capital flowing into these large cap companies that then became mega cap companies because there's simply a lack of options for capital flows to go to. And then on top of that, we have the issue of passive investing, which is been really kind of driving the markets. But, you know, there's really kind of two things about that. So first is that as an investor, right, so markets follow earnings. And again, if we go back to thinking about the Russell 2000, you got 40% of that index that's non-profitable. So again, if I'm going to be buying a company, I want to make sure those earnings are growing. And growth in earnings are the biggest driver of stock market returns, right? Because people are willing to pay up for earnings as they're growing, and then you have to have a valuation reversion when earnings stop growing. Well, the vast majority of earnings are only coming from large cap companies. They're not coming from the small and mid cap space. That's why 40% of the small and mid caps are not profitable because they're not making any earnings. So earnings growth is incredibly important to this whole story. And again, you know, for those saying that, well, the mega cap trade is over, be a little bit careful because the earnings growth, as I said, has only come from large caps. In fact, if you look at earnings growth for the mid cap and small cap companies, right, there isn't any. Now, analysts are very optimistic that by the end of 2024, there's going to be this big surge in earnings for small and mid cap companies, but that's dependent on a fundamental change to the economy, that the economy is growing a whole lot stronger. But again, during a period where the economy was growing very strong, right? In quarter 3 of 23 and quarter 4 of 24, you had the economy growing at nearly 5% in quarter 3 and 3.5% in quarter 4, and they couldn't make any money. So what's going to be the driver that all of a sudden makes small cap, mid cap companies go, oh, I can make money now when the economy is slowing down, right? That doesn't make any real sense. But that's what the expectations are for Wall Street. And again, they are historically very wrong about earnings growth. They're always overly optimistic. And so I would be a little cautious potentially about that outlook. But again, the other big change to this, and one of the big drivers, so we've had, you know, one of the reasons mega caps continue to kind of absorb capital flows that we talked about is due to passive investing. And again, more and more advisors, as well as more and more individuals, are just opting to buy, just opting to buy an ETF, right? I hear about the AI trade. I don't go try to pick out the AI stocks, right? I just go buy an AI ETF. Like, and every time some new trend or fad or whatever comes around, there's an ETF company that goes, oh yeah, I'll make an ETF for that, right? Because people will buy it, right? So it's about creating product. But you have 37% of the S&P 500 made up of 10 stocks. So every dollar, when people dollar cost average in their 401k plans or an index fund or an indexed ETF, 37 cents of that dollar is going into 10 stocks. That's hard to suggest that all of a sudden that mega cap trade is over. We'll wrap this up on the other side of the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
This is the worst coffee on the planet. I'm filing a class action lawsuit against my firm for buying this coffee. It's absolutely terrible.
The Real Investment Show podcast.
I think you bought this coffee too.
I offered you some Death Wish coffee.
I don't want to die this early in the morning.
Same show, your schedule.
There needs to be a nice balance between coffee brands, okay? Can't have complete crap and Death Wish. There's got to be something in the middle.
At realinvestmentadvice.com.
Black Rifle.
There you go. We don't have any here, do we?
No.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. So you heard that break over the break. You heard the commercial about the coffee discussion we had last week. Well, Brant very nicely left on my desk this morning a box of Black Rifle coffee pods. So it's pretty good coffee. I have to admit, it's pretty good coffee. So
That's the high octane stuff.
yeah. Yeah. So I'll be talking a lot faster here for the rest of the show. It's all good. So anyway, just wrapping up our conversation about whether or not, the moment of mega cap dominance is now over. Now, look, let me just be clear, is that at some point that will be the case. As I've said before, I have no idea what causes it, but there will be a point that a rotation will occur and money will come out of those mega cap stocks. The problem with that is knowing what causes it. And unfortunately, when that occurs, it's not going to come out of just mega cap stocks. It's going to come out of everywhere, because you're now talking about having to get people to sell their index funds and their 401k plans, their ETFs that they hold at home. I mean, this is some event will occur that will cause this unwinding of assets across the board. And yes, small caps and mid caps will outperform, but that's a real dangerous statement, because all that means is that while the mega caps are down 50%, small and mid caps are down 40%. So you're still losing money, but they outperformed. They only went down 40 and the market went down 50. So be careful when somebody tells you, well, during a crash, these stocks are going to outperform something else. That doesn't mean they're going up. It just means they're not going down as much as everything else is. And that could be okay, right? If you have to be invested 100% of the time, that could be okay. But you know what really outperforms during a crash is cash. So, and bonds. So there's alternative assets to be into. So be careful when somebody tells you, it's like, well, I just saw, in fact, I just saw a chart this morning. It says, during market routes, healthcare tends to outperform over time. They go back through these periods in history during election years and stuff. And it shows that healthcare outperforms by 10%. And you go back and look at those periods, as they were down sharply, just not down as much as everything else, right? So just be careful. Be careful with headlines. So just talking a little bit about passive investing and that flow of money that's just going into these big companies is not going to stop anytime soon, because again, there's nothing at this moment that has changed the mentality of the markets. Another issue with the mega cap companies, of course, that drives them is share buybacks. We've talked about this before. And if you take a look at share buybacks as an example, we're looking at more than $1 trillion worth of buybacks this year. Now, Apple makes up almost 10% of those buybacks all by itself, right? So that's, and again, if we go back to 2000 and look at the drivers of equity markets going back to 2000, the net purchases, right? So the positive net purchases, there's been more than $5 trillion of purchases of shares by corporations since 2000. Their purchases are basically 100% of the net equity allocations to markets over that period of time. In other words, while retail investors and others were buying or selling, etc., the net purchases, so you subtract out the buys and the sells, almost 100% of the net purchases all came from corporations through buybacks. And this year we're expected to hit a record. And the companies that can afford to do these buybacks are large cap companies. Like I said, Apple alone will make up 10% of this number. And if you take a look at small and mid cap companies, they simply don't have the capital and the wherewithal to execute large scale buybacks. So again, when we start talking about the demise of the mega caps, there's a lot of conversation about that. You got to step back and go, okay, that's fine. And I do agree that at some point we will see a reversal of this mega cap dominance, right? We saw it during the dot-com crash. The question is what causes it? Because right now, all the underlying drivers, liquidity flows, buybacks, earnings, all that. Just be careful. The whole point of this is just to be careful with these headlines, because again, it's these make great headlines, and it's something worth paying attention to, but it can also lead you to making the wrong bets. I have this chart here I wanted to bring up for you, just explaining this whole corporations have been net equity buyers. So this chart since 2000, pension funds have had a net outflow of 2.2 trillion. Mutual funds have had a net outflow of 0.5 trillion. Households have increased equity allocations by 0.6 trillion. And foreign investors have increased it by 1.8 trillion. So if you take those four, right, take 2.2 and 0.5, that's negative 2.7, right? And you subtract that from the 0.6 and the 1.8, which is 2.4, right? You basically have a wash. So that leaves the 5.5 trillion. as being the sole net purchases by corporations of equity demand since 2000. So that's where that number comes from, if you're wondering. So, but anyway, so the point is just be a little bit cautious about headlines and about these type of things, because it just leads us to make bad investment investment decisions over time. And these narratives can, scare us. And again, I got lots of phone calls last week, lots of emails. Hey, I read this headline that says the AI bust is over and we're long NVIDIA. What do you know? Well, we already took profits out of it. But there's nothing that's changed the market environment. So be careful going, okay, I got to get out of everything and go to cash because this is the moment. Maybe it is, right? Maybe this is the bigger correction. And again, I certainly expect at some point this summer, I still expect a 3 to 5 to 10% correction, right? And we're maybe in that process now. Maybe we started that corrective process this past week, and that certainly aligns with historical norms. You go back and look at July's. The first half of July tends to be strong. The last half of July tends to be weak. And well, there we go, right? We're in the last half of July and we've had a bit of a correction so far. That could certainly go further, right? We can certainly have that 5 to 10% correction this summer we've been talking about. And if we begin to break more moving averages and break more support, we'll raise more cash. We'll reduce equity risk further. We'll increase our bond exposure. We'll hedge, do those type of things. But there's no evidence of that at the moment. We just simply had a bit of a rotation last week based on headline-driven narratives. And we'll see if that continues this week. And we'll see what happens. So again, just the whole point of this is just be a little bit careful. Now, tomorrow, like I said, we'll get into the mid-cap, exploration a bit more. Is that, drive of mid and small caps sustainable? So we'll go through all that kind of data tomorrow with you as well. But again, that's where we are. Stock futures this morning are pointing higher. So, that's, again, part of the consternation last week for the markets was the uncertainty about the Democratic side of the ledger coming into the election, right? There was all this conversation about Biden needs to drop out. He says he's staying in, lots of uncertainty. Well, now that's been resolved. So now futures are this morning starting to look at, okay, what does a Kamala Harris presidency look like? And now they're going to start looking at, okay, well, what sectors potentially, if she wins the election, are going to benefit from her and her policies? That's going to go back. Obviously, she'll carry the same torch for the Democrats that President Biden was, so they'll focus on clean energy and student loan forgiveness and these type of things. More the socialistic leaning policies, and that's what the market will start to try to adopt here over the next couple of weeks as that becomes potentially more. Now again, part of the uncertainty right now is who's going to be the vice presidential candidate. There's a few people kind of picked out: Josh Shapiro, Roy Cooper, a couple of others that are kind of on the short list for VP. So we'll see who she picks. But that pick will also have some influence on the market short term as well. But again, now that the presidency question is mostly resolved in the market's mind, we still have to go through the convention. But right now, the markets are going to kind of resolve around Kamala Harris being the candidate and resolve that accordingly. So futures are pointing a little bit higher because that uncertainty risk from last week is starting to get resolved a bit. So again, just, we'll kind of watch. Today, economically, we've got the Chicago Fed National Activity Index. That's expected to come in at negative 0.6. That was 1.8 positive 0.18 positive in the last read. So again, that kind of aligns with now the Chicago Fed National Activity Index doesn't get a lot of press, but it's over 80 different indicators in that one index, hard and soft. It's a very, very good economic leading indicator. That, not surprisingly, is weakening because of the economic weakness we've seen in other areas of the economy over the last month of reports, right? So we'll see that this morning. It'll be interesting if it comes in even weaker than expected. All right, quick break. We'll come back, get ready to wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. A couple of things, this week is going to be a big earnings week for the markets. Today we've got Cleveland-Cliffs, Nucor Steel, SAP, Truist Financial reports today. So Truist, PNC, those are those mid-cap kind of regional banks that during the Silicon Valley bank crisis, they got completely hammered because of concerns about their viability in respect to their collateral with the Fed hiking rates, et cetera. Most of that risk now seems to have resolved itself. But today we'll get a good look with Truist Financials. They're a mega regional, right? They're a very big regional bank. And again, they're kind of while Silicon Valley Bank was very big, PNC, Truist, these are very, very big regional banks. So we'll take a look at their earnings and see if some of this collateral risk has been resolved. Take a look at their charge-offs, loan loss reserves, those type of things, to see if there's still risk in that mid-cap banking or kind of that middle banking sector. And again, we've seen these banks recover nicely over the course of the last couple of months. PNC is in our dividend equity model; it's done well, along with the rest of the financials, J.P. Morgan, Goldman Sachs. But we'll see, again, Truist is in that same venue. The concerns there have been collateral and commercial real estate. These regional banks own a lot of the commercial real estate loans. That's where most of your commercial real estate loans are done, is through kind of the regional banks. So they hold a lot of commercial real estate loans. So we'll kind of get a good look at their books today. Then tomorrow is we start getting into the big boys, right? So we have Google tomorrow, along with Capital One, Comcast Communications, Enphase, Freeport-McMoRan, Gold and Copper, GE Aerospace, General Motors, Lockheed Martin, Philip Morris is tomorrow, Spotify, Tesla is tomorrow as well, UPS, Texas Instruments, and Visa. And then we get into earnings on Wednesday. Is Chipotle Mexican Group, the world's most expensive burrito. ServiceNow is on Wednesday. Ford Motors is on Wednesday. And then on Thursday, we start getting into some of the retail guys: American Airlines, Deckers, Honeywell, Juniper Networks, Dr. Pepper. who else here? Texas Roadhouse, others. So again, we're going to start getting into a lot more of these names. So earnings are going to pick up a lot this week, and the next week is going to be the kind of the big bulk of earnings. We'll get a lot of the big mega cap companies coming out over the next week, and then by the time we get to the week after that, 80% of the S&P will have reported. So we're going to be through two things here very quickly. Over the next 2 weeks, we're going to be through a big chunk of the earnings, and the buyback window for corporations will open back up. So the one thing that we've not had to our benefit right now and during this correction this past week is we haven't had the benefit of buybacks, because that window is closed right now for effectively all S&P 500 companies, because we're into that window of reporting earnings. So as soon as they report earnings, their window will open back up and they can start buying shares again. So again, by the time we get through the next 2 weeks, really the kind of the middle of August, so to speak, that window will be open for buybacks. And so we'll start getting that support coming back into the markets. A good bit of economic data out this week as well. On Thursday, we get the second quarter GDP estimate. Now, again, that number's been all over the board, right? The Atlanta Fed GDP had started out at nearly 4% GDP growth. It went to 1.7. It's now bounced up to about 2. The estimate for second quarter GDP right now, the advanced estimate from the Bureau of Economic Analysis, is at 1.9. So that's not great. We're continuing to see slower rates of economic growth, but if that comes in, say at 1.5, 1.4, where it was basically in the first quarter, that's going to kind of weigh, kind of on sentiment about this whole stronger economic recovery. And if we see weaker economic growth, which it wouldn't surprise me seeing some of this recent data, if that number comes in weaker than expected, that should bode well for bonds, but it should also give the Fed more room to cut rates. And again, right now, expectations from kind of the market is that the Fed will cut rates 3 times this year. The sentiment from the Fed is they'll cut rates twice. So once in September, maybe November, and then once in December. So we'll see if they cut rates before or after the election. But expectation of the Fed, 2 cuts this year. The market's now expecting 3 based on recent data. And again, we'll, as we get through this week and see that GDP number on Thursday, we're going to have a little bit better estimate about how aggressive the Fed is going to be. If that number comes in a lot weaker than expected, that's going to tell you a good bit about where we're headed, both with inflation as well as Fed rate cuts as well. Okay, I think that's pretty much the important stuff. Few things just to kind of wrap up to pay attention to here. Credit spreads. I talked about this it was interesting. So I did the Thoughtful Money interview with Adam Taggart on Friday, and we did the whole interview. It was like an hour and a half long. And at the very end, I said, oh, by the way, this is a chart I'm kind of watching, which is credit spreads. And this is credit spreads between CCC, the most junkiest of junk, right, and B-rated bonds. So this is low-quality bond spreads out there, right? And so that spread is beginning to widen. And I've talked about before, if you really want to know what's going on with the markets and what your risks are, pay attention to credit spreads, because that's all you need to know. And we're starting to see those increase just a bit, right? And this was a passing comment that I made with Adam. And of course, this is the headline of his whole, of the whole video. Credit market cracks, right? Again, be careful of headlines. Again, there's nothing bearish going on right now, but there are certainly some concerning things that are happening. And it's worth paying attention to credit spreads, because they do tell you if there's risk within the financial markets, because again, that's where it will show up, is in credit spreads. And again, we're talking about the junkiest of junk. Now, if you look at the spreads between BBB and AAA rated bonds, there is no credit risk, right? You take a look at spreads between BB bonds and A-rated bonds, there is no risk, right? Those spreads are very, very tight. Only in the junkiest of junk are we seeing credit spreads starting to widen. Now, can that spread, is that where it starts? Yes, that's typically where it starts, because that's where the economy is weakening. And companies that are already on the verge of going bankrupt, those are going to be the first ones to go. right? An A-rated company is not going to go bankrupt in a slowing economy, but a slowing economy can get to a company that is already non-profitable. Again, 40% of those Russell 2000 companies are non-profitable. So there's not a lot of room for them to survive if sales and revenue declines in a slowing economy. So again, that's why you're starting to see those credit spreads widen on that end, right? It's a very, very early warning indicator. It's kind of like going outside and there's some clouds in the sky and you stick your finger up in the air and go, may rain, right? Way early to tell. But it's worth paying attention to because that's where it starts. But don't, again, the headline is meant to scare you, which is not good because you don't want to try to scare people into not doing anything, right? It's just something worth paying attention to. If you listen to the rest of the interview, it's basically telling you what I'm telling you today is that there's not a lot of risk. Let me show you this chart real quick on the VIX. So last week was this massive sell-off in mega caps, right? And headline Wall Street Journal this morning, stock market rotation of historic proportions is taking shape. If that was the case, volatility would be surging higher. Can you see that little number on the far right-hand side down there near the lows? That's where VIX was on Friday. That certainly doesn't suggest that there's any major risk going on in the market. Certainly doesn't suggest that there's this major rotation going on right now within the markets. But again, these make great headlines. Certainly scary, right? Certainly makes you want to do something. I agree. But sometimes just you got to wait. Now, what can you do? Same thing we were doing last week. Take profits out of stocks that are grossly overvalued, grossly extended, things that have had big runs. Take some profits out. Just reduce those back to target. Taking profits does not mean sell everything. Gold has had a very big run, right? Take some profits, right? Had a big reversal on Friday. Got very extended, right? So again, just you've got speculative longs in gold, very extended. Now, whenever you've had speculative gold longs, as long as they are right now, you've had decent corrections in gold prices, give you a better opportunity. So sell a little bit, reduce your position size back down to normal, and then next opportunity, you add back to it, right? No big deal. It doesn't mean sell everything. Just take some small actions. We talk about a lot on the shows about, it's a game of inches. Make small little changes here and there. They'll have big impacts down the road. So if you take some profits now and things, reduce things back to target weight, if the market does continue its correction, great. I've got cash that I can go buy those positions back with at a lower price. And there's a lot of people out there that weren't long NVIDIA, Apple, Microsoft, et cetera, in their portfolios looking for a time to get in. They're about to get that opportunity. Maybe not today, maybe not next week, maybe not this month, right? But eventually you'll get an opportunity to add those positions to your portfolio. So again, just as is always the case, just don't overreact and really don't pay attention to headlines because those really get you into a lot of trouble. All right, wraps up the show for today. Thanks for joining me. Be back tomorrow. We will talk a little bit more about the Russell trade. Tomorrow I've got an article coming out in the morning kind of going through all the backdrop of that and again, kind of some of this headline narrative. Is it real? Does history support the headline narratives? We'll go through all that tomorrow with you right here on the show. Of course, get you up to date on earnings and everything else that's going on. Be sure and like and subscribe to the channel. Certainly appreciate that. You help us grow, and we appreciate that. Also, get by the website. Our latest newsletter is out, as well as our daily market commentary out on the website this morning already. So get by the website, realinvestmentadvice.com. You can subscribe to those. Free email delivery. There to help you out. Absolutely free. And we'll see you back here tomorrow.